All right, we are about 2 minutes away from getting this thing underway. Thank you to those of you who are, again, patiently waiting as we get ready to kick off another weekly edition of our stock market analysis. All right, 10 seconds to go. I got my water preemptively filled up for this stream, so we're going to have a nice, refreshing, clean beverage for once I start getting talking and refuse to stop. But that is the end of the timer. Let me X out of the notification. Thank you to those of you who are joining us on this special Labor Day weekend edition of the stock market scan. We've got a 4-day week coming up in the market, which is why we're doing it on Monday night as opposed to our typical Sunday night stream. But hopefully we're still going to have plenty of good content for you. Recapping what happened last week, we turned a profit of $205 in what was kind of a wild week for those of you who are following along closely because things got pretty crazy down at the wire, but we'll talk about that in just a second. Overall takeaway from last week is that the S&P 500 dropped 3.22%, which is a pretty significant drop in the market. But once again, we squeaked out a green number, and I think that green number is significant, even though it's a relatively small number. But if we go to our year-to-date summary, we've now railed off, and I guess this bottom one is next week, but we've railed off 9 consecutive profitable weeks for a cumulative $28,223 of profit, and we have really, gained on the S&P 500 and Nasdaq, extending our outperformance on the year. As you can see, they've come off a really, really nasty slide. I think both of the respective indices between the S&P 500 and the Nasdaq have dropped like 8.5 and 10% respectively. Yet during that time, we've been relatively flat. And again, let's talk about the overall strategy excuse me, as we head into the next week in the market, right? The biggest shortcomings I think we had were we kind of played every single week the same at the front end of the week. And, it's easy to kind of be asleep at the wheel a little bit when 2021 was such a good year for us. And I realized that I actually need to update the title of this chart at some point because this is 2022, but we'll worry about that a little bit later. But anyways, it's easy to fall asleep during 2021 when the market went up pretty much every single month of the year. We're finally seeing a little bit of a challenge in 2022, but our biggest issue is we kind of played everything the same. And while our strategy did allow for us to be a little bit flexible during the downturns in the market, you'll see that we have big green weeks sprinkled in, but those green weeks are really only sprinkled in after big red weeks. So after enough, we're the blue line right here, after enough volatility to make our head spin, during the first third of the year, we decided, okay, heading into May, enough is enough. We anticipate that the market is going to continue the volatility due to a lot of the macro events that are going on with the Fed easing QE and interest rates rising. I don't think it's going to be a straight shot back to all-time highs. So we adjusted our strategy to kind of account for that. And in doing so, the idea was, look, these red weeks, they're going to happen in the market. The market is volatile. And yeah, they did continue to happen. And the market really, especially from, April-ish, is still decently lower than where it was about 5 months ago. But with that said, we wanted to avoid these big red skids up front and then put ourselves in the position that we would have been for when we get these big green weeks on the back end. And I think what we've done over the past 3 weeks has been a phenomenal demonstration of, scaling in on the front end and avoiding the big dip, because the last few weeks we've seen a minus 3.22% week, we've seen a minus 3.99% week, and a minus 1.16% week. And those are 3 red weeks in a row, right? In between that, we had a $54 profit week, we had a $16.15 profit week, and then a 205. So cumulatively over those 3 weeks, we've actually taken home almost $2,000 in profit, which is, still a decent number, but especially impressive in the face of such a sharp drop off in the overall markets. But I think that's the equivalent of what these weeks would have looked like in the past. Now the question is, how can we take our portfolio and get ourselves into a position where we're getting something like this week, or, one of these 5-figure profit weeks? And I think, we'd be remiss if we didn't have the biggest takeaway that we've had so far in the market this year, which is that things can always get worse. So we don't want to get too crazy into any positions and potentially, face another one of these red weeks, because again, things can always get worse. We're still above the lows of the year, so I don't really see a reason we can't revisit them. So we still want to play somewhat conservatively, yet we want to give ourselves a little bit of some upside for the coming week. And you can see that here as we have a $2,700 base profit set up for the upcoming week. And you can see that there's a little bit of premium left on these, so I guess a little bit of a spoiler alert. Max profit, if we kind of move down the list here, bear with me as my computer tries to catch up. Come on. Max profit is just over 4,000. And again, that's with no new trades. That's just off the base portfolio that we have set up for the coming week. Last week, we got $2,400 off of new trades. So there's definitely a lot of room to add to this and potentially get a better figure than 4K. But that's kind of the idea that we have in the coming week, that we're hopefully going to see a little bit of a bounce in the market. We left some upside on our positions, and hopefully we're going to see the benefit of that as we nicely avoided the detriment of the decrease before. And if you look at futures right now, you can see that the S&P 500 futures are up about 0.75%, which is decently significant over the weekend. So always happy to see that kind of price action, meaning we may get the bounce that we've kind of been hoping for here. But with that said, let's talk quickly about what happened last week. Some very typical wheel trades that we had: DraftKings, Open, Fubo, Affirm as well. And Affirm is a great one that I really want to talk about here, because we look at these, the initial trade that we had right here was on row 974. We sold 5 23 strike puts, and we did it for 80 cents a piece. You'll know that that's $80 per contract times 5 would have given us a max profit of $400 if those, expired worthless for max profit. But let's take a look at the Affirm chart, because I think this is a phenomenal example of how scaling into trades can be very, very effective for us in a volatile market like this. So you'll remember that the typical strategy that we like to employ when we're scaling into a trade is set it up, and if it stays above the break even, don't touch it, because as long as the stock price is above the break even price, we're going to make money, and there's nothing better than not touching a trade and making money off of it. So our break-even price off this one off the bat was the 23 strike minus the 80 cents of premium, meaning 22.20. However, it did get below 22.20 on Thursday morning. It's that red line that we have illustrated right about here. Excuse me. So we took that opportunity on Thursday morning to scale into the second portion of the trade. And the second portion of the trade was the 22 strike for 54 cents of premium. And those individually carried a break even right in this neighborhood with, 2 days till expiry. So we figured that was a decent spot to throw those. And remember, we said that our max profit on the initial position was $400. Now, since we hit this level, and we did bounce off of it, but we honestly barely finished above this level. We got back up to about 22.40-ish at close on Friday. And we did close the 23 strike puts out for a few cents. I think it was 22 cents. To avoid some downside risk headed into Friday afternoon. But the main point I'm trying to get at here is that, one, when we scale into trades, we have a smaller position up front, so it reduces the risk on the front side of the trade. And two, sometimes in situations like this, which are very, very common, right? Because what goes up must come down. What goes down, frequently bounces back upwards. When we scale into trades, remember that original trade right here at a max profit of 400. We made 290 on the original trade and 270 on what we scaled into. So we ended up with even more profit on this trade than what we originally set up for. And that's because it dropped against us and then subsequently bounced very nicely, which is fantastic. We love to take $560 away from that, especially on a very red week in the market. Bed Bath & Beyond worked really well for us. I mean, it finished up at 860, so it kind of tested that 8 strike near the end of the day on Friday, which was a little bit scary, and I think we closed that one out a little bit earlier in the afternoon just to take the risk off the table, and I'm fine paying $40 to have a little bit of peace of mind and lock in a $330 gain. The AMC trade, which was our free trade of the week in the Discord server right here, that bagged us $210. So the little strategy that we had, right, where, it's okay to throw a little bit of money at these meme stocks because these stocks are relatively disconnected from the overall market. That right there gave us $540. Now, the big overall decrease in the market hurt a lot of our more traditional wheel trades like DraftKings, Opendoor, Fubo, as those lost about $500, $460, and then Fubo dropped about $210 for us. But again, these netted out kind of nicely, right? If you go down the list here and get to our spreads, I mean, that's $245 of profit off of our typical HT wheel trades. Snap was a really good one. I think Peloton was a good one. And Newegg were some of those higher IV type trades, but they worked out all the same. And some of these higher IV trades give you these larger downside cushions. So while the stock can move a little bit more crazily on a day-to-day basis in the market, those larger downside cushions really do a lot to protect you in a week like this when the market is pushing down. And I think we demonstrated that by being overall profitable on the H2 wheel, despite the fact that some of our larger positions got hit a little bit harder. Now, the excitement in last week came with our much discussed 0-day SPX spreads, where these are unfortunately not in chronological order because I kind of hate inserting rows on the bottom of the table because it doesn't pull down to the profit and I have to update the formula, which is a little bit of laziness on my part, admittedly, but let me try to walk you through the craziness that is our SPX spreads during the week. So the very first one that we had was actually a roll from the previous week that we opened and we closed for a slight loss, but on Monday morning we had to roll that one immediately, and we know that we typically like to get about a 2.6, 2.7, 2.8 closing debit on these. However, the quote-unquote worst case scenario happened, which is we rolled these 0-day SPX spreads overnight, and it opened up, below the long leg that we had. And we like to, obviously be outside of that long leg. So if it breaches intraday, then we're able to roll and get that 2.6, 2.7, 2.8 closing price. But one of the risks that strategy has is what happens when that long leg gets breached overnight. And that's what this looks like right here. We had to take a $1,260 hit. So at this time last week when we were talking to you during the stream, it did not look good for having a profitable week because futures were getting crushed. We figured we were going to have a decent loss on this off the bat, but even though we dropped $1,300 off the bat and the market went even further down, we still turned a profit. So let's kind of move through the process right here. So the very next day, we opened another bullish spread, and we did that with the 3975. And this is kind of crazy, right? Because the initial short leg that we had on our SPX spreads was 40.45. And that is way up there compared to where it finished. You could see SPYs down at 392.24 to finish the week. And you could also see that by 9.2, some of these put spreads that we were opening were like 3.89. And with the exception of one spread here, which was a call credit spread, which we, finally got the direction right on something, which gave us $225 of profit, everything else here was a bullish put credit spread. And the fact that we opened essentially exclusively bullish put credit spreads on a week when the market went down 3.22% and we still made money on spreads, I think that is a phenomenal testament to how effective and flexible this is. So we talked about that little, 1260 bath that we took in the morning. That was not ideal, obviously, but I believe we could find it right there. The other one that we opened right off the bat, we rolled these things down. We kept the same quantity because we didn't want to take ourselves completely out of the game from a portfolio perspective at the beginning of the week. If we had doubled down, we would have gotten $570 more, but sometimes better to be safe than sorry. And it can be a little scary sometimes to trust the process, especially in a shaky market. We don't want to throw ourselves too far out of the game off the bat. But point being, that ended up working, and this netted out to like a what? If you add these cells together, it's a $690 loss. So obviously never a great way to start the week off, but it's better than the 1,300 we were looking at, and you kind of build from there. So the next day in the week, Tuesday, August the 30th, again, we started with another bullish credit spread because the market was looking oversold. We're going to keep playing that idea of mean reversion, meaning that RSI is going to work its way back up to 50 so that if a stock or an index like SPX is overbought, it's going to come back down. Or if it's oversold, as it was last week, it's going to come back up. And unfortunately, it kept moving against us. So this initial trade that we opened right here with the 39.80 short leg, we pretty much got chased like I think less than an hour after we opened that one, which was frustrating because then we were looking at a roughly $1,100 loss on SPX. But we know about the flexibility that these 0-day SPX spreads offer, and since we got breached so early on in the day, I thought it was a decent idea to roll same day, which I typically don't do, but I think when it happens early in the morning, it's a decent enough idea because you could potentially have the trade resolved before the end of the day. And that's exactly what happened, right? We rolled our 39.80 short leg down and out, or excuse me, just down to a 39.35 short leg, and that's a pretty significant roll right there, going from 39.80 to 39.35. That's almost a 1% extra cushion on a daily basis. And again, we increased that position size so that if you take that 510 loss and net it against the 665 gain on leg 2, even though it moved against us, we still netted $155 on Tuesday. So let's move forward to Wednesday, August 31st. I'm getting my days all messed up. We opened another bullish one with the 39.65 short leg. And as was kind of par for the course there, we got chased out of that one as well for a $435 loss off the bat. We increased position size. We rolled down. We rolled out to 9-1. And again, we took that short leg from 39.65 to 39.15. Again, that's decent progress. That's over 1% further down. Yes, the market could drop very, very quickly, but also if you give yourself, a 1% cushion at a time, you're typically going to do pretty well on these rolls. The key is just to have a level or a certain point at which you say, okay, this is too much, I'm done, and I'm starting over. For us, that was here. Because when we rolled down to that 39.15 short leg, it also got breached for a $1,100 loss. And all of a sudden, we were looking at a $1,500 loss on this third day of spreads after having two, blow up in our face shortly before that. But stick to the plan. We rolled down. We went from 39.15 to 38.85 and just about doubled that position size, and we were able to recover 15.75. And that isn't just recovering 15.75 because, in fact, if you net all three of these together, we came out with a profit of $20 off of these, despite the fact that in a roughly 36-hour period, S&P 500 SPX went from 39.65 down to 3900-ish, moving against us, but we have the flexibility to roll down, roll those strikes down, increase the position size, and we recovered, and that takes us to Friday, September the 2nd, where we started finally with that call credit spread, where we bagged $225, and we said, you know what, that's not enough for us. We're going to keep on going bullish again because I think if you take a look at the S&P 500, it's honestly a crazy chart on Friday because I think at around 11 or 12, there you go right there, right at noon, I mean, this thing fell off the map, which was kind of crazy to see, quite honestly. But again, we have the flexibility to manage that. We got chased, we rolled down, and since it was, there were still 3-ish hours left in the day, this one, we got chased almost immediately from this one, admittedly. But since there were almost 3 hours left in the day, we kept the same expiry but increased the price. We rolled down from 39.40 to 39.05. Now, this one was a lot scarier because you could see there wasn't just this initial dip, but at around 3 o'clock, there was another very, very sharp dip. And I think pulling up the SPX chart would maybe be the best way to illustrate the chaos that ensued at the back end of last week. So if this chart loads for me really quickly, we'll remember that we rolled down to 39.05, the short leg. And you will see, we always want to wait for the long leg to be breached when we roll these, right? And 39.05 was the short leg. So we're waiting for it to breach 3900. But it bounced right off of that 39.05 short leg. And what you'll notice by looking at this line is that, look, this is also where it bounced off of on Thursday, which is why when you pick your strikes on these SPX spreads, choosing levels is very, very important. Lots of things bounce off of similar levels that have been previously established. Looking left on the chart is a very, very helpful exercise when picking your SPX spreads, and it worked to a T. Friday afternoon, and I'll be the first to tell you that was kind of stressful because this candle right here is happening at like 3:40, 3:45, so there's like 15 minutes until expiry, and we're playing with a rolled position. And we actually got a little dicey there, saying, okay, this drop right here that we saw was so crazy that we opened 3 more for 55 cents down at 38.90 because that was all the way down here. We figured that was okay-ish for 5 to 10 minutes in the market. But again, this one finished for a net profit of 170, even though we had to roll those. The earlier call credit spread that we had in the day finished for $225 of profit, and the little gamble we took at the end of the day with those 39 or 38.95 put credit spreads back to 165. So all in all, despite the fact that we had yet another one move against us on Friday, just on Friday individually, we pulled $560 from those credit spreads. And again, these are very, very flexible. We started off the week eating a $1,300 loss, yet all in all, we made $45 on the spreads. So that is just a testament to how effective I think the zero-day SPX strategy is. The one caveat, of course, is have that number that you're willing to quit at, because it's very apparent how quickly we can recover some of these, and the market goes up, the market goes down, trading in this kind of wavy pattern. If it's early in the day and something has moved greatly in your favor, close it out. I mean, there's no better insurance than the actual guarantee of taking profit, like at 11 in the morning, and not having to worry about a potential 100-point drop in SPX. Because while it may seem unlikely and there may not be a lot of premium, you might say, okay, well, if this was this likely, there'd probably be more premium left. I'm just going to bleed out the extra $100. It's been very apparent in this market recently just how quickly things can move against you. And that is not the only big move we've seen, right? We've seen some pretty crazy intraday moves to the downside here. I'm a big believer in the whole stairs up, the stairs up, elevator down, where it's a slow climb up, but when the market does get moving down, it could happen very, very quickly. But all in all, that is how we pulled a $205 profit out of our ass last week, despite the fact that the S&P 500 dropped over 3%. It's how we've continued our overall outperformance of the S&P 500 and NASDAQ since we've been publicly tracking our trades since July 20th. And in that time period, for all these publicly tracked trades, we're outperforming NASDAQ by 115% and S&P 500 now by 103.45%, and we hope to continue building on that. We've got a great question, if I could unhide the chat here. There we go. What's the best way to estimate an option opening price after the stock has gapped up in after hours, as far as entering an order to buy back a CSP? Now, what I typically like to do when I'm trying to get an idea of that, and I will say the first piece of advice I'll give to that, if you're trying to kind of guess where an option is don't put your order in before the bell. Let the market decide the price. Now, I think it's also very useful to get a decent idea or estimate of where that option is going to open, and here is how I do that. So let's say, is there anything we could find on the watch list here that actually gapped up after hours to make an example of this? I don't really think so. But let's take Apple, for example. So we can see that Apple closed at 155.81. Now, let's say Apple gapped up to, 165, and you're like, okay, I have 165 call or something like that, and I want to know how much it's going to be worth at open. So what I typically do is say, okay, if I had a 165 call, that means that it'd be worth roughly what an at-the-money option is. So an at-the-money option is roughly 156. So even though, when the market closed on Friday, the 165 strike calls were 21 cents, with that hypothetical gap up to 165, you'd say, okay, instead of being worth 21 cents as it was worth at close, it'd probably be worth closer to what an at-the-money option is, meaning $3-ish. Since that's roughly what it looks like the market dictates for an at-the-money option on Apple. Now, when you have big gaps up or gaps down, that's also typically going to include a little bit of a change in implied volatility. And if anything, that would increase the premium a little bit as well. But that's the best way, I think, to get an idea of what an option is going to be worth after a big aftermarket or pre-market gap up or down. But again, I think the best practices there is just to, the market is pretty efficient at pricing these. Let the market price it for you. Don't try to guess some limit price, have it fill it open, and then find out 5 minutes later you would have done $500 better or something like that. But that is typically the way that I like to estimate it. So that wraps up last week. We're doing really, really well. I mean, especially we're hoping to get 10 profitable weeks in a row here and make our way almost back to break even. We are so very close. Slightly unlucky looking number right there, but we're moving back up, right? We're only down 5.19% year to date. And the S&P 500 is now down 17.42%, while NASDAQ is down 26.54%. And again, we've done all this while basically setting $40,000 on fire in January with a little bit of a margin mistake where we got a little bit I guess a little bit cocky with how easy 2021 was, but we've adjusted the approach going forward, and since then we've pulled $30,000, and in that stretch, that's since February, and that's back when the S&P 500 was at 448, and it's now down below 400. So we've still made a significant amount of money from February onwards with the current strategy that we have in play, which I feel is a much safer, more consistent approach, and no better way to illustrate that than actually looking at our account balance on a week-to-week basis. You can see where we had a lot of volatility in there, and then we decided, okay, that's enough. Let's just slowly build it back up and fight, or I guess let the volatility of the market work for us. So unfortunately, don't anticipate any of these crazy 15, 20K weeks anymore, but I think this is a much better path to have than having to worry about the 15K down weeks as well. So with that said, how are we going to accomplish that this upcoming week? How are we going to aim for our 10th consecutive week of profit in a very, very shaky market? The first thing we're going to do is update this to say the week of 9/4. And let's talk about what we've got from top to bottom. So a lot of these are trades that we rolled over from last week, just following our typical HT wheel process, right? If you look at DraftKings, we lost $500 on DraftKings last week. So what did we do? We rolled these 16.5 strike puts down to 16. Meaning that we're going to recover 440 on those if DraftKings stays flat, putting us at a net loss of 60 on a week-to-week basis. But we also said, hey, off this big dip in the market, we want to be a little bit more aggressive. So we doubled the position size at a lower strike, meaning we'll also get 400 more bucks. So even though we started playing DraftKings when it was at like 17 for this most recent cycle and lost 500 last week, so long as it just stays where it is at 1549, which is still over a 10% drop from where we started playing it, we're still going to bag a net profit of $340, and this plays into our overall DraftKings trade that we've had since December of last year, where DraftKings is one of those included in that bucket of stocks where we've had some severe decreases in the stock. This one in particular has dropped 56.97% since we entered into it. If we actually just straight up bought shares when we entered into it, we would have lost $41,000. However, thanks to our HT wheel strategy and the way that we have been managing this trade, we are set to have a profit of $120 and actually make money on this thing overall, despite this huge move against us. So it's one of those things where we like to tread water. We want to keep our head above water as things are moving against us, as evidenced by, this kind of flattish line in the face of a dip in the market. But once things get moving for us, this number that we have at the very bottom right here could get moving upwards very, very quickly. And one trade that we wrapped up last year that we like to talk about is the GHIV trade, where we similarly had a stock move decently against us. And this had gotten down like 30-40% against us at some point. Not quite as severe as DraftKings, but you could see these big initial losses. They happened. There's more big losses in here that you can kind of pick out. But by the end of it, we turned a profit of $11,209 by the time it was all said and done. And that was still despite the fact that it had dropped between the time that we started and ended the trade. So just some really nice proof of concept to have in the back of our minds as we continue to trade this strategy. And hopefully DraftKings will be another one that we could add to that, Hall of Fame trade list where we, rolled with the punches as it moved down against us. And reaped the rewards when it finally decided to bounce back up. But again, that's one we've got on there. Open Door was trading it, I think, halfway between the strikes-ish. No, it was trading at 410. And last week we had, let's see. We had 4.5 strike puts. We had 20 of those. And I didn't really want to keep rolling those to 4.5 because there wasn't a ton of extrinsic value at the 4.5 level. So the little compromise that I had was splitting it in half. Instead of rolling 20 out to the 4.5 strike, I did 10 at 4.5, 10 at 4, and that's going to net us $180 if it stays flat, which isn't obviously quite recovering this 460 loss, right? That gets us to a net 280 loss. But again, we have some upside here because we want to play the market to bounce a little bit off such a really, really rough stretch. So if Open Door does make it back up to 450 this week, all of a sudden, these two combined bring us $580, and that easily wipes out the losses that we saw on Open Door last week. So that's the plan right there. Let me undo that. Fubo, we rolled to a 3.5 strike put. Again, that one that leaves us a little bit of upside on Fubo last week. We lost about $210. If Fubo just stays flat from where it currently is, that's $340 worth of profit, so that'll eliminate that. And to be fully transparent, if you go 2 weeks back, we lost a little bit more on Fubo. So we are definitely hoping on that bounce back to 3.5 to get us a little bit more even on that one. But again, we like to talk about scaling into trades on Open Door and Fubo. I'm perfectly comfortable doubling those positions, but every time you double a position, that's one of the most effective ways that you could combat a dip in the market. And you don't get infinite double downs, right? I doubled down on my position on DraftKings, but it's not like I have infinite money in my back pocket to double down, double down, double down. It's really smart to save that cash and double down when things kind of start to get away from you a little bit. And I really don't feel that between Open Door and Fubo, they've even begun to get away from me. So if they do start to get away, that's when we'll think about putting 20 more contracts a piece on. But no sense in worrying about that until we cross that bridge. Everything is perfectly manageable in its current form, and this is what we're rolling with. With the firm, very similar strategy. Scaling in, very similar to what we did last week, right? Where we start off with this initial 5 contract position. For those of you who are newer following along, our full contract size for a firm is going to be 15 contracts. So this is roughly a 33% sized position. And if it, again, drops below that break-even price, we sold a 22 strike put for 92 cents, meaning our break-even price is going to be 21.08. And on a week-to-week basis, where is it? 21.08 break-even. The stock closed Friday at 22.45. We've got a 6.10% cushion. And so long as a firm stays above 21.08, we're not going to touch it, because that means that if it finishes above 21.08 on Friday, we've made money. We've got absolutely nothing to worry about. But if it does, we'll scale in similarly to how we did last week, and maybe we'll be in for another pleasant surprise where we'll remember that, like we talked at the top of the stream about 30 minutes ago, our initial max profit on a firm last week was 400, but because we scaled in and it bounced a little bit, we took home $560, more than our initial anticipated max profit. But again, we've got $460 of max profit if this thing finishes above 22. We're going to let it ride and let the market, do its thing. SoFi, another one where we split the strikes, and I believe we doubled down on this one as well, right? Because we only had 10 contracts last week. We sold 6 strike puts for 15 cents. We closed those things out on the roll for 27 cents, which is a $120 loss. Went. But on the 6 strike puts, we were able to recover 100 just if this thing trades flat, leaving us at a net $20 loss. So what did we do? We added 10 more contracts to 5.5 strike, giving us $90, meaning that so long as SoFi, even though that we started trading it at like 610, 615, so long as it stays above 575 this week, we're still going to net a profit. And, $70 is one of those don't spend it all in one place type profits. But the idea is that the market could keep moving against us for a lot of these stocks, but we have this backup plan, we have this contingency plan that's still going to allow us to turn a profit. Peloton was a great one for us last week. We sold a 9.5 strike put. That was another kind of fun one. And I think one that might be useful to pull up the chart really quickly, because we talk about levels of support, we talk about levels of resistance, and we like to sell around those. We previously identified the fact that Peloton bounced off of this 9.5-ish level, I believe. And that held true. It did bounce, Wednesday, Thursday, and then fell back down Friday. But where did it bounce off of Friday? Look to the left on the chart. It bounced off where it previously bounced off of Tuesday. Held the line at 950-ish. And while we didn't quite hit max profit, we were 3 cents short of it. We were able to take home $160 of profit. Now we're back in on Peloton, an even lower strike, right? Because we had 9.5 last week. We rolled that thing down to 9 this week, and we're hoping to bag $230 of profit on that. And the last one, we have this one under safer trade as well, because we're going to be handling this one similarly to DraftKings, similar to a firm, or I guess kind of most similarly to a firm, where we're in 33% sized position. Max profit off the bat's 455. We sold a 29.5 strike put for 91 cents. That's going to give us a break-even price of 28.59. And so long as this thing stays above 28.59, we're not going to touch it, because that means we're going to be making money. And again, the message that we try to convey at the end of the little portfolio rundown that we have for the coming week is this is just a very preliminary list, right? If you scroll up to previous weeks, these little purple new indicators that we have in column G here, there's a lot going on a week-to-week basis in the market. You look at just last week, we made $2,390 of profit just off of the day-to-day trades that we alerted in the server that looked very nice to us as intraday opportunities. So we have this base profit of $2,700. We have, max profit, so to speak, because we wanted to leave ourselves a little bit of upside, right? So if we get the bounce on DraftKings to 16, and before I run through this exercise, I want to illustrate A bounce to 16 on DraftKings is not something that's terribly far-fetched. Going from 15.49 to 16, not that big of a bounce, right? Fubo to 3.5, SoFi to 6. These things are not out of the question. But if we run these things down, these things expire worthless, even though we have that base profit, so to speak, which means that if the stock doesn't move at all during the coming week, we get $2,700. Our max profit, if we do get a little bit of a bounce in our favor, is going to be a little bit over $4,000 for the coming week, which would be a very, very nice prize on a 4-day week that we've got here. But again, with that said, plenty of opportunity to add some new ones there and increase that 4.1K max profit number. Let's see what we've got. Nye Smith in the YouTube chat checking in. What's going on, Nye? Thanks for watching and dropping the comment. And yeah, the Excel sheet. This thing's our baby, man. We've been working on this. We've got 2022, we've got 2021, and we've got 2020 in here. We could go to the 2020 real quick because it has definitely grown and gotten a little bit more sophisticated since we've started this thing. But yeah, the idea is the same, right? Just track those weekly trades, manage those break-even prices, keep the thing moving, and then, after a couple years of publicly tracking, you get some nice feedback from people, and then you end up with something like this. But this is what we've got for the coming week, and I really am fine with potentially adding some more things tomorrow morning. However, we look at the S&P 500 futures that we have right here with /ES, which is probably very, very small on your screen, admittedly. I might need to make this text on Thinkorswim a little bit bigger, but they're up 0.64%. That's decently green. I'll be the first to tell you that. And, we want to be spending when the market drops. When the market's going up, like when the market is up 0.5% or up a full percent and the trades that we are in are moving upwards, don't touch it, right? No need to mess up a good thing. We've got a very significant amount of cash in our back pocket. I think we, with margin-ish included, I think we have about 100K of buying power currently sitting here. So we have a lot of ability to scale further into trades and open new trades when we see fit. However, there's no need to fill your account up to the brim every single week, right? We know that we like to target a roughly 1% return every single week or something a little bit north of that, because we know if we get 1% every single week, that annualizes to about 67% on a yearly basis, meaning we're going to make a very, very, we're going to make a significant amount of money if we pull 60% a year. I'll be the first to tell you, we're not going to pull 60% every single year, but our goal is to outperform the market. And targeting this number, I think, is a good week-to-week goal to set for yourself. But with that said, evaluating, do I have enough positions? Do I need more? Look at this number right here off the bat at your base profit level. If your base profit is above 1% off the bat, I think you have plenty going into the week, especially if you've got cash in your back pocket. There have been several weeks over the past few years where I've been managing margin calls as opposed to being a buyer of good entry opportunities. And that's something that we've definitely worked on and done a lot better with this year. So it can get boring sometimes to have cash in your back pocket, but if you're not spending the cash, it means the market's going up. And if the market's going up, there's no complaints, right? I will be a very happy camper and silently take the $2,700 profit if we can get it. So let's do a little bit of research, right? We'd like to have some names in the back of our mind heading into each week and say, okay, what could we potentially enter in on? And I guess one quick discussion that I think might be pretty helpful is we said, okay, last week we made a little bit of money off Bed Bath & Beyond. We made some money off of AMC. And that Bed Bath & Beyond trade was, fantastic. We could actually run through this one really quickly because I think this is a very, very important example. If you frequent the Theta Gang subreddit on Reddit, I actually posted this example in there, and the people were not too happy. Reason being is this is one that's focused a little bit more on implied volatility, and they like to focus, and implied volatility is the Vega Greek, and they like to focus a little bit more on theta. So it was outside of what they're typically used to, but a little controversy never hurt anybody, right? But this is a great example of why I think this Bed Bath & Beyond trade, and just in general, some of these meme stocks, so to speak, are actually really, really good option selling opportunities. We've got Beanie Boy. Don't know how serious he's being, saying that he's, taking my advice and taking a 100K loan. But just to make sure we don't mince any words, never trade on debt. Never trade on debt. But for those of you who have followed our SPX spreads and have seen success, I've had a few people reach out to me and let me know. I love to see it, man. It's always fun when we can win together. And it's not like there's so little liquidity in the market that anyone's hogging a certain trade or anything like that. But it's always fun to be in on these as a team and kind of have that community feel when we jump into these. And rest assured, if you follow me on a trade and it doesn't go well, I'm losing with you. But you could also rest assured that we probably have a plan B, plan C, plan D to rescue that trade. And that's a fantastic segue into this little Bed Bath & Beyond recap, because we had plan A, plan B, and plan C, and it turned into $604 of profit for us. So let me quickly pull up the Bed Bath & Beyond chart. Let me take the chat back off the screen really quickly. But yeah, here you have it, right? You have this huge initial spike going from like $8, $9-ish up to 30 at the peak. And what you could see from that, it probably is a little easier to see if we go to the 180-day chart. There you have it. You have this big jump in implied volatility, which is the blue line right here. And every time we see a big spike in implied volatility, I love those option selling opportunities. And why is that? It's because on 819, which 819 on the chart is right around here, when this thing was in the mid to low 20s, and I believe the stock was actually at 23 a share when we entered into this, we were able to sell a 10 strike put, something that I think was, 3 days until expiry and over 50% out of the money, and offered over a 1% ROR, which again is that weekly target that we love because it annualizes so very nicely for us. But what we did there was we sold 10 of those. And I think maybe that one mistake that we made was not just taking profit when things got back down to like 3 or 4 cents. It was a situation where it seemed like, okay, this thing can, let me actually zoom in a little bit more here for you guys. But it was definitely one of those things where we thought, okay, how bad can it really get? And, when stocks are this volatile, things can move quickly. These are some big red candles. Let's zoom in a little bit more closely here. We were cruising into that Friday, and I think that Friday was 8/19. Here you go. We were cruising into it with the stock at 1841, and after hours, it was announced that day that Ryan Cohen had abandoned his entire stake in the stock. So it went from 1834 down to below 12 a share on Friday morning. Now, if we had not been greedy and just taken these and left like 50, 60, 70 bucks on the table, we would have made a killing on Friday morning. However, we did not. We actually rolled out of these and into 2 sets of 12 strike puts. So these were closed by Thursday afternoon, but we did have both of these open. And we were gunning for about $400-ish of profit. Nothing to sneeze at for sure. And I thought it was a really nice risk to reward ratio. And even though these moved sharply against us, we knew that was a possibility. But what I love so much about these high IV trades, and you'll see in a second as we move through the lifespan of this trade, is that when implied volatility is this high, $400 is pretty nice to get on 12 strike puts when you've got something trading all the way up here and your strike is down here. But of course, the risk is you get a big red candle like this, and we saw a big red candle. But the consequence of that isn't us just saying, oh shit, and losing the trade. It's okay, we knew that something like this could happen, and we had a contingency plan in place. So the best part about when implied volatility is inflated like this is you can get a lot of premium deep out of the money. I think it is a basically suicide wish to sell something dead at the money. There is a certain Redditor on that subreddit who lost, I think, about $600,000-$700,000 by putting majority of their count into like 15, 16 strike puts. Not a good idea. Take advantage of like these tail options that are decently far out of the money, but still get a little bit of a kick from this spike in implied volatility. But with that said, at open on Friday, the 12 strike puts, they were in the money. We don't want to be in or at the money. So we closed those things, and it sucked because we went from looking at like a $400 gain to what netted out to be a $2,290 loss on Friday morning. But, we have every single trade we open. It's not just plan A, we're done. We have plan A, we have plan B, we have plan C. We could combat this kind of a downward move. So plan B was, again, starting with that further out of the money. We increased the position size, right? We had 20 contracts going into the night. We closed those out. And we rolled those to 10 strike puts, right? You're not going to recover this, 2340 in an 8-hour trade. And I think chasing that kind of a loss is just going to lead to a bigger loss. So we said, let's make the objectively smarter trade. Let's go further out of the money. Let's recoup $900 of that by rolling these to 10 strike puts. And then let's recoup a little bit more by opening 9.5 strike puts right at the bell. And that alone recouped $1,180. So by the end of the day on Friday, even though when we had closed these things Friday morning, we were looking at a loss of $2,340 by the end of the day on Friday, 8/19. We were only down a little bit over $1,100. So we said, okay, we had 30 contracts, I think, at one point on Friday. How can we significantly reduce our risk and put ourselves in a position where we can make that money back? And being in a $1,110 hole, we said, okay, let's look out of the money. And for 826 the next week, we saw 9 strike puts trading for $1.12. We said, how many of these would it take to recover that? And we decided to sell 12 because that significantly reduced our position size, meaning it significantly reduced the amount of risk that we had in the position and still put us in a place where as long as Bed Bath & Beyond finished above 9, we'd make money on the trade, and that's exactly what happened. It finished above 9. That netted us out to a $234 gain. And then the premium was still a little bit high for last week, ending in September the 2nd, where we were able to get 370 more bucks on that. So all in all, over the 2.5 weeks, I think, that we were in on this trade, let me zoom out to make sure I have my dates right. Yeah, 2.5 weeks that we were in on this trade. We entered August the 15th. We got out on September 2nd. We netted a $604 profit despite the fact that we started this thing at 23, meaning Bed Bath & Beyond in the beautiful move that it had moved 62.48% against us, yet we were still able to turn a $604 profit. And for that reason, I think these high IV stocks like this are a fantastic option selling opportunity, provided you're able to take assignment, roll week over week, and go deeper out of the money on your initial position. And I think the effectiveness of the roll can really be demonstrated by looking at our break-even price tracker, right? Our initial break-even price was $11.79. When we added those 9.5 strike puts, and then rolled down to the 10 strike puts, they got down to 10.56. And then when we reduced the position size and went a week out and a further strike down, we dropped that to 8.82. And then finally on 8.26, when we sold the 9.28 strike puts, that lowered our break-even price to 7.40. So even though we started the trade with Bed Bath & Beyond at 23 and it dropped below our initial break-even price, roughly 11 days after we opened the trade, we put ourselves in a situation where even though it was below 12 and we were temporarily losing money, so long as it finished, that first week of September above $7.40, we were going to make money overall, and that's a significant reduction. You can see that number conceptualized right there, a 67.83% reduction in our break-even price. And with Bed Bath & Beyond wrapping up the week at 863 last week, that was enough to handle it. Now, what I will say is this is an IV-centric trade, right? We highlighted this blue line spiking up and falling back down, and I actually snipped it out because it looks a little bit better on that 180-day chart, and I use it to illustrate what I wrote up. But we love the opportunity right here. Once implied volatility falls back down to this 1.86 level, you could kind of draw a little sloppy line. That was, not too bad for freehand right there. But you'll see that it's that implied volatility that it was at the end of last week, last Friday, is a little bit more in line with where it typically trades at. And when implied volatility surges, option premium surges. Consequently, when it comes back down, that option premium gets sucked back out a little bit. So now that it's at a more, reasonable, more consistent level with where it previously had traded, there isn't this idea of extra IV-induced option premium that's going to go away when IV falls. Especially looking at this on like a 3-month timeline as we have drawn out right here, I don't think it's going to fall too much lower than this in the short term. And, that's kind of demonstrated if you look at the option chain for the coming week, right? Sure, there's a really, really nice ROR at the money, but if you wanted to go further out of the money like we previously did, going, $1 or $2 out of the money to 6.5, you're not even fetching $100 at that strike. So at this point, the IV has demonstrated that it's fallen back down. And because of that, I think the opportunity is largely gone, but definitely a good one to keep on the watch list in case it does spike back up, right? We could pull up the 1-year chart. This isn't the first time this has happened, right? It went up to 30, but this also happened back in March as well, where there's, not as significant of an increase, but there still was enough of one to make a little bit of money off that. But with that said, not in our portfolio, but on the watch list for the coming week. So let's, we're almost an hour into this and I've been rambling a little bit, but let me take a nice sip of water and then we'll get into some of our option scanners and try to come up with some new ideas that we could potentially have our eye on for the coming week in the market that we can add to this and potentially increase the profit number that we have displayed. As always, a phenomenal sip of water. I don't think water has ever tasted better than when you have just spoken constantly to yourself for roughly an hour. But with that said, hopping over to the scanner, let's start with just the very typical, bare bones scanner that we talk about on our YouTube channel, the old high ROR puts without earnings, which is going to objectively give us the highest premiums in the market. This is a good starting point. And again, not everything at the top of this list is a good investment idea. However, again, it's just a starting point. See what's going on, get a lay of the land, and kind of go from there. Peloton 9.5 strike put. You see that one pop up. We're already in on that. I think that's a good one to potentially be in on. VERU is a biotech stock. GSAT, kind of interesting one right here. This is a satellite company that I remember from a while ago. And I believe that they spiked up at one point because there were rumors that their technology was going to be used in one of the new Apple phones. And I'm sure if we go look at GSAT and go to like a longer term chart, there it is. It was just about a year ago today that they had that initial spike that I recall. But here's what you got, right? We already have a line drawn in the sand here from some previous analysis, God knows how long ago. We have it running back up here. Implied volatility is, I guess, a little bit higher than where it typically is, but maybe not significantly so. We can go to the 1 year and get those scripts that we've got. IV percentile, I mean, it's 97%, but we've definitely had higher IV in the past on this thing, as indicated by the IV rank of 25. But with that said, decent amount of premium on there. Let's see what's going on. We can sell the two strike puts. And a great question from Nye Smith right there saying, how do we get the percent out of the money filter into the scan? And I think if you simply just add filter, go to option, percent out of the money is at the very bottom of the list that they give you. So nice and easy to pull that thing in there. But again, having this thing at like a minimum of 0.01% ensures that everything on here is out of the money, and that's exactly what we like to sell. So with GSAT, this is actually pretty interesting, right? Because we like to look left on the chart to see, okay, where might something stop? And yes, the two strike put is what comes to the top of this scan because, oh yeah, 10% ROR, I mean, 20% premium, that's going to get you a $1.80 break-even price. But look, at $1.80 break-even price, in the context of the price action we've seen over the past year, doesn't look phenomenal. You know what looks a little bit better is this roughly 150 level. Why is that? Because it looks like it gapped up above that. It gapped up above that before climbing up to the 204 that it's currently at. Back in March, the very end of March, it topped out at this 1.55 level before going back to 1 and then ultimately breaking through. What do we know when we talk about support and resistance? We know that previous levels of resistance that have been broken through become levels of support. So let me remove this drawing as well to show that, I mean, you could give yourself basically a 25% cushion on this thing by going to a 1.5 strike. And I mean, the spread's a little wide, so it's tough to say exactly what these are going to be going for. But again, a 1.5 strike is a very, very low strike, provided you could get 2 cents or more, which you definitely can because 2 cents is the bid. In theory, I mean, you know, if you go right at the mid, you get a 3% ROR, which I think is a fantastic number. The only thing I think we need to wrap our heads around is, okay, what's potentially going to happen this week? We've got an MMM of 51 cents, which would theoretically put the low end of the range again right back at 150. But let's check the news to make sure they don't have anything too crazy going on recently, and it doesn't quite look like it. It looks like it's up again on some more Apple rumors. So I guess that's basically the life and death of this company. So I mean, nothing too crazy here. We haven't seen any significant gaps down except for past the big gap down off the initial spike that they had, which was a much bigger spike than this steady jump. So I love the idea, honestly, of taking, I mean, I wouldn't even call it a flyer. I love just taking a smaller position of some of these 1.5 strike puts. Yes, the number of these that you're going to have to sell to generate meaningful profit is going to be a lot larger because they're like $30 a pop. So you'd have to sell like 30 of them to get $100, which, you know, has $15 of commission as well. So commission's somewhat meaningful at this level. But I don't necessarily hate the idea of going 1.5. These things have weekly options, meaning there's some decent opportunity right there, but one to potentially keep an eye on. So we're going to pop back to our little list that we've got over here. Let's do GSAT 1.5 strike put. And, you know, if you want to get aggressive, maybe the 2 strike. I just don't love the 2 strike. We look at RSI on a 1 year basis. It's cooking, meaning we typically expect that it's going to fall back down. Another question from Nye, if I bring the chat back on here really quick. He meant the scan to the right of your ROR filter. How do we get the percent? Oh, I've got you. I got you. So right around here. If you click the little cog right here and click customize, you could bring in all sorts. I mean, the list is insanely long of what you could bring in here and sort by. But again, percent out of the money is just another one of those, and we bring those in, we sort it, and that's how we get a nice little concentrated, sorted look at the scan results. So let me hide the chat again really quickly, and let's keep going down the list. Revlon is a company, battling bankruptcy, but one that stopped us before. I'm not a fan of it. SST, this is one I definitely remember. Let's take a peek at what's going on here. A SPAC, former SPAC. I think that is why I remember that one. Nothing, and I really not a lot to get out of bed for here. This thing's hard to borrow, meaning that it's probably very heavily shorted. And we've seen, especially over the last 20 days, this thing's gone from 708 to 14.5 to 11.62. In no way, shape, or form does this look like sufficient premium to help us survive that. But while we are on the topic of SPACs, I have a very, very interesting option buying idea this coming week, and it is going to be a Tuesday, meaning tomorrow, trade. So let's actually talk about that really quickly. And it is with one that's been talked about sometimes in our Discord server. More4, if you are on this stream somehow, shout out. I know this is one of his favorite stocks, but what we have here is DWAC, Digital World Acquisition Corp. We could pull up the 1-year chart, and it's going to paint a very scary picture. This was, the typical SPAC chart, except this thing got way out of control off the bat, right? You have this $10 net asset value. This thing peaked at 175, which is far, far higher than these things typically peak at. But as you typically see in the life cycle of these, it is petered off. Now it currently sits at $24.99 a share. Why is this significant? Because the net asset value of this is 10. And another thing that is very, very significant is there is an event Tuesday afternoon, tomorrow afternoon, where they decide if they are going to complete their merger with Truth Social, which is the Trump social media company. Strictly avoiding politics in this discussion, there are a lot of issues, both financially and logistically, with completing the merger. So on Tuesday afternoon, if it is determined that they're not going to complete this merger, this stock could go back down to 10, which is the net asset value. So what does that mean? When we look at the money here, these things are trading for like $1, $2. If you go to 20, you buy one of these things for 53 cents and it goes back to 10 on Friday. These are going to be worth $10. That's a 20x return on your money. Now, I'm not so confident in this that I'm going to throw like thousands and thousands of dollars into it. However, with a stock that typically has this high level of IV, and this being a very, very focused window of when we're going to try to execute this trade, I think opening these sometime tomorrow and getting out first thing Wednesday morning, if it doesn't work, is going to be a phenomenal way to limit potential losses. And if you want to give yourself a little bit more time, you could also go out to September 16th, and you pay about double premium, but you get double, if not more than double the time frame. And I think that's a really, really decent opportunity if you're looking for like a lower risk, potential high payout, as they have that vote on Tuesday afternoon. I wonder if they've got, there you go. MW deal for Trump's Truth Social to merge with SPAC faces collapse. And if it collapses, this thing is going right back to net asset value. You've got quotes in here saying, "We look forward to the successful vote, yada, yada, yada." La, 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 la. What am I looking at in here? Yeah, there's a probe that's going on. There is a lot of issues with what's going on right here. And let me, wrote some notes down on my phone. Give me 1 second. I know this is some really great, production for you right here. And I cannot quite find the notes. So we'll update this in the Discord server later. But I think this is a very, very interesting quick in, quick out. If it doesn't work, it doesn't work. We take like a 20, 30% hit on like a low risk, high payout. But if this thing works and this thing goes back to $10 a share on Wednesday or anytime before the end of the week, this is literally a 20x return. I think every now and then it's fun to mix one of those in. We got a question from Beanie Boy 69123. Very creative string of numbers right there saying, how much is our premium Discord? Great question. On a monthly basis, and first off, you can get a free month of the Discord by signing up for Webull. You could also get a free week of the Discord server just as a test no matter what. But it is $25 a month. It's $225 a year. If you want to join for lifetime, it is $399, and that's subject to increase at some point soon here. But to sign up, you're going to go over to hourglass-trader.com. Hopefully it loads a little bit more quickly for you than it did for me, but go to Join HT Premium right there. And I think once you click on that, if my computer gets its act together, you're going to see all the plans right there. If you have any questions, feel free to reach out to me on my Discord server. But you get all these features that we see right here. I think the most important being that you get access to our premium Discord server, where you're alerted to every single trade that we make as we make it, the entries, the exits. You get it all, right? You also get access to the premium chat room where there's a lot more information. We also have some bots in here that alert us, for when there are certain situations, like when we talk about the implied volatility spike on Bed Bath & Beyond. You get alerted on that, and it happens with other stocks as well. Every time a stock gets halted as well, there can be some pretty advantageous opportunities there, so you get alerted to whenever there is a halt and when things are unhalted. And these are great because you could toggle them on and off by interacting with this message right here by just clicking on the emojis. But a great way to have a more mechanical approach to your trading where you can, follow along with what we do as we do. And really just it's a good way to generate different ideas by having some of these informational channels that we intend to continue to build out in the future. But that is enough of the self-promo for now. But again, hourglass-trader.com, if you're interested in joining that. Feel free to reach out to me if you have any questions. But DWAC, DWAC, I think that is an interesting low risk, very potential high reward trade. So let's get back to the scanner, see if we've got anything else that looks interesting before we go to the more focused scanner. And what the hell, let's go flip it over. Actually, Wayfair is like such an interesting stock to me with how the premium works because it's very low volume. The spreads get kind of crazy on the bid ask, but you could go very, very far out of the money on a weekly basis on this thing and find a very, very decent premium, right? We look at the 1 year chart, very, very oversold. I mean, IV is relatively high, not as high as it's been. Because we can go to the 3 year and see that it's been much lower than this, 21.7 at the COVID base. But the big trend that we have in a lot of these stocks, when we look at the long-term chart, meaning the 3 year chart, what we're looking for is where it is in relation to its pre-COVID highs, because that's the pattern that we've seen a lot of these stocks fall back into. And the Wayfair pre-COVID highs back in January of 2020 were roughly $100 a share. I mean, you've got the 21.7 low of COVID, but that bounced pretty quickly, and it's starting to level out and find a home in this mid to high 40s level. So, I mean, if you want that 1% ROR per week, I mean, you can absolutely find it at at like 43, which is crazy on a weekly basis, because if you go to the, I guess maybe the last month that we've seen here, 43 is down here. And yes, that may seem very attainable. And again, there wouldn't be premium on there if that wasn't attainable on a short-term basis. Let me be the first to tell you that. I mean, but especially if you look at this thing on maybe like a 10-day basis, where's 43? 43 is all the way down here. So long as you stay above this red line for the next 4 days, you're going to be bagging that, 1% ROR. But again, volume is, shockingly low on this for how high the premiums are. And it may be a better candidate for some of those scale-in type trades, right? Where instead of targeting a 1% ROR with a 100% size position off the bat, we take a 1/3 size position and target a 3% ROR off the bat, which still gives you a 48 strike. Subtract a 150-ish premium on that, gives you a 46.50 break-even price. And boom, you're rolling into next week where you've got a break-even price right here with 1/3 size position, and still upside of about $150 a contract that you sell. And I think there's also decent, margin privileges on this, right? Because fully cash secured, that costs $45.6K if we wanted to sell 10 of them. But it looks like Thinkorswim TD Ameritrade only requires about a third of that. So not too bad right there. Definitely want to keep on the watch list in case it gaps down at any point, because like these gap downs that it has it open sometimes are great because they're almost immediately recovered in a lot of these situations. But Wayfair is one that I've had my eye on it, but I haven't quite pulled the trigger on it recently, but not a horrible opportunity. And then a couple more we'll look at here really quickly are just the very, very low dollar ones, because while these may not be the greatest fundamental investments in the world, some weird stuff happens with these lower strike level options where they're very easily manageable. They could spike up, spike down. A lot of the time, if you just hang in there, you'll be okay. But FFIE is one where there's now premium at the $1 level, right? And a lot of these crappy, I mean, it's a crappy stock. Don't get me wrong. To further the SPAC conversation, this was a former SPAC, and it's now almost below $1 a share. But literally back in July, this thing was at like $8 a share, which is batshit crazy for what this company is. But with that said, with it at one, not a horrible idea if you just accept the fact that this is a risky trade, right? Because if you're able to get like 5 cents of premium off this for a one strike put, that's a 95-cent break-even price, and that's still like a 5% ROR, which is significant on a week-to-week basis. And again, if you get that one strike put, you get assigned at a 95-cent basis. Okay, go to next week, sell something that's slightly out of the money for 5 more cents. All of a sudden, you're at 90 cents. And can it get down there? Absolutely, but it's kind of the game that you play here a little bit. And another one that I see on there that isn't as familiar to me is TELL. Let's take a look at TELL, if I can right here. Tellurian Inc. I have no idea what this is. First thing we want to do is zoom out to get an idea of what it looks like. And this almost looks like the classic biotech stock that had like bad news and is kind of slowly recovered and been very volatile. Let's go to the Analyze tab to double check on what this thing is right here as it brings it up. It is an energy company. Very, very interesting to see price action like that from an energy company. But what we've got right there is gas, which has been, admittedly a little bit volatile lately. I don't know if they have anything in particular coming up. Nothing that I can really tell. It looks like they had a senior secured notes offering, which at least should secure the company a little bit of cash. Not that it's the greatest for the stock price, but it tends to prevent bankruptcy type events, which are the big disasters you want to avoid, obviously. But if you wanted to bite off 15, 16, 17 cents of premium at a 4-strike put, that'd put you at a 385 break-even price. And if we look at this over the last 20 days, 385 break-even price, that's it's not too bad. I got to be honest with you. I don't hate that idea because, again, this thing has weekly options. Dead at the money, this thing's telling you that you can get 20 cents right at the money. So even if you have 385 break-even price, come Friday, you could sell a dead at the money option. That'll get you down to 365, and you kind of see how this thing starts to go together week by week by week by week. And again, the one, assumption there is that implied volatility stays at the current level it is, but it looks like, especially over the last 180 days, there haven't been any significant fluctuations in implied volatility. So I think at least in the short term, we could potentially count on that to stay there. So I don't hate the idea of selling 10 of these and trying to steal about $170 next week. Let's throw a TELL 4P. And again, these are a little bit on the riskier side, but that reward is much, much higher, right? We're looking at a 4.58% ROR fully cash secured and plenty of option premium to manage those things on a week-to-week basis. And hell, I'll even throw FFIE one strike puts on there if we could find a good fill on those as well. Again, those aren't the best fundamental trades in the world, but they're kind of fun ones where you could take advantage of these inflated premium numbers. But with that said, we've talked about this in our YouTube videos as well when we try to comb through the results of these option scans, right? You have 862 different options on here. We like that these all have decent premium, but look, I don't have time to go through 862 different options. So how can we find those? We know that we love to talk about RSI as a great indicator of short-term price action. So which of these have that indicator that they're going to bounce? And the answer to figuring that out is going to the intersect with function and finding which of these are oversold. And that's just a simple stock scan that indicates when RSI is low that we're going to be intersecting this with. So we go from 862 different results of stocks that have 862 different results of options with high premium to now 9 different results of high premium options, which are also on stocks that have been decently oversold lately. And from there, you get a much more concentrated list. And I've found historically that these honestly are much better at giving you some meaningful entries at the beginning of the week. XPEV, I think, is a Chinese electric vehicle company. If you want to get in the way of this and take on some additional risk that one comes along with investing in EV companies and two comes along with investing in China, Be my guest. The numbers say it's a decent idea, right? With this thing closing at 1674 last week, it looks like you could get 1% ROR at 15.5, which is down, still down here. Still a decent little gap, especially when we could zoom in a little bit and go to the 10-day. You've got protection down here on a 4-day basis. Remember, this next week is a short week. So if you want to play the numbers game, this mathematically should be a decent place to play it. However, the number one rule that I think you should follow when selling options, which will ensure that you're being pretty safe, is the fact that, you should always sell options on stocks that you are comfortable owning. So this just is not one that I'm comfortable with owning. XPEV, see you later. Now ZIM is a different story with these 34 strike puts. ZIM, we're going to see a big red candle because they paid a dividend last week. There you go, $4.75 dividend. Consequently, you see a roughly $4.75 decrease in the stock. So that means when we're looking at the 180-day chart here, we're going to want to add about $4.75 to the price of these stocks to get an idea of where it actually is. And that would take us to roughly 39 and change, which is right around here. And if you extend that to the left, you're just below this level of support that it established back in the beginning of July. So with that said, I think it's a decently attractive entry for an investment, right? It's definitely fallen off the wagon a little bit. Implied volatility, hasn't necessarily dropped like a rock or anything like that, especially over the last 180-day period. Hell, even over the last 180-day period, it's, the Ivy ranks 44, so middle of the road. 27 is relatively low on the Ivy percentile side, but let's take a look at the option chain and see what we can get. And the answer is that we can go down to 32.5 and get that 1% ROR that we crave on a weekly basis. However, 32.5, the way this thing moves, I don't hate the idea right there. However, following this theme that we've had with Affirm, that we've had with Shopify, that we've used with DraftKings and I guess are using for the coming weeks, is we still want to focus on scaling into these trades. So I don't necessarily want to take on a full position size at 32.5. I think I'd much rather take a half position size at 33, where you get that 2% ROR. You get roughly 65% or 65 cents rather of premium to give you a 32.5 roughly break-even price. And I think that's a very, very decent place to start this trade. I know that the margin privileges on this one are pretty solid. So instead of selling 10 of these and maybe taking like an 11%, maybe like 15% sized trade in my portfolio, we'll maybe start with half of this, which wouldn't be too bad right there. That only takes about a third of the buying power. Really not too bad at all right there. Let me think about this. Yeah, right. So $250. Not a bad way to try to snag $250 for the coming week, selling 5 of these. And I think I am comfortable taking about a $30,000 position size because if you do the math right here, and I'm definitely thinking out loud here, apologies for kind of rambling to myself. But like if you owned a full position at like 31 basis, that's $31,000, our portfolio size. And again, you could adjust these numbers to fit your portfolio. But that comes out to like an 18% size position in our portfolio. Definitely on the higher side, but if we got into that, I think we'd be able to use that premium pretty effectively on a week-to-week basis to get to around 30. This company actually has some decent fundamentals. Has a history of trading much higher. It definitely has a history of trading lower as well, but we like to look left on the chart. Where's this thing bouncing? Right around here. I don't hate the idea of jumping in on this one right here. Let's take a look really quickly and see if there's any more analyst ratings. There you go. Just on August the 19th, there was a price target of 63 on ZIM, which is, basically 100% upside on them. So they've got decent sales. They did miss, but they're definitely making a profit. 11.07 EPS, which is a phenomenal number. And I think that's fine. Bank of America had them at underperform with a price target of 40, but again, 40 is still above where it is at 34. I'm happy to initiate a position on this one in the low 30s. I love the idea, I think, of jumping in on ZIM at a 32.5 strike put with a half-sized position, 32.5p, and then 50% sized. So that's, I think, a decent one, which again has come from this more concentrated scan. Splunk, which is like a, I think, IT type company, SPLK. It's an internet company. I forgot exactly what they do. Forgive me. But again, another one where you see this intersection on a long-term perspective. If we go to the 1-year chart of low RSI, we've got that thing in the blue. And why do we love RSI so much? I think we talk about this every single week because it is such a phenomenal indicator of short-term price action. The last time RSI got into the blue right here, yes, it was dipping down pretty hard, and that's what causes it to go down that low. But within 2 weeks, it had already bounced right back up. So it's getting back down into the blue. We are at decently, historically speaking, this is a phenomenal price level because you have not 1, not 2, not 3, not 4, but 5 bounces off of this price level that we've drawn here at about $86 a share. So potentially jumping in on this thing. The premium isn't massive or anything like this, but I'd be fine with just selling, even one of these dead at the money to initiate like a 50% sized position. Now, I will say, is 85 a price that we'd want to own this at? Yeah, it doesn't look too bad at all. Go further to the left, it's below the COVID low. Let's take a look at the news really quickly to make sure nothing's going pretty crazy here. We have a $125 price target. We have a $135 price target. We have a $95. We have $145, $117. And again, those are all far higher than where we're sitting here in the mid-80s. So I love the idea of a mid-80s SPLK cash secured put. And again, we could just sell even one of these at an 87 strike. It doesn't have to be too big of a position. They really don't require much margin at all. They require like a sixth of the overall buying power. So like from an ROC basis, this is like a 10% return on your capital. But again, be mindful of how big your positions are fully cash secured, because you don't want to just load the boat on these, not have the market tank and say, oh no, I accidentally went way too deep on my margin usage. So SPLK, love the idea of like an 87 strike put. Try to grab a couple $100 off of that one. But again, a great example. We didn't like option 1, but option 2 and option 3 provided some very, very nice entry opportunities from an option selling perspective. Let's finish out the exercise with STX and VOD. So we go to STX. Seagate Technology. I don't really know exactly what this stock is. We talk about this long-term trend of returning to pre-COVID highs. Where's the pre-COVID high? It looks like it's right around $64. That is exactly where this stock is at. So I think this is a phenomenal entry point. Again, we've got that RSI trending towards the blue. We've got implied volatility coming back up a little bit for us right here, right? IV percentile is 86. IV rank is roughly middle of the road at 47, meaning there's still some decent premiums there. But let's take a look at how good those premiums are. 65, not too terrible. You can get 1% ROR down at 63. Which isn't the worst thing in the world. Let's take a look at the last 10 days. Look, you've got a stock that went from 80 to 65, did bottom out at 63.5, but that's a $14 decrease. Granted, there was a pretty large decrease in the overall market. Let's check the news. Hard hit tech sector has 3 high yielding stocks you should know about. There you go. They love this one. What else do we have? Any price ratings? We've got 93, 88, 72. 93, 70, 88. That's, again, well clear of 65. And not to say that these banks can't, do a 180 and, again, adjust those further down. But I think it is to say that decent potential entry point on Seagate, a great way to provide some more diversity to the portfolio and just add another trader right there, which we think we should be able to decently manage with our option selling strategies. This looks like a phenomenal place to potentially own here. I don't know. They do pay a dividend, so let's double check really quickly to make sure that we're not going to be falling. Looks like September 23rd might be when they would pay their next one. It doesn't look like there is a skew at all here. So if there were a skew, which I imagine we might see up at the 30th of September, we don't really see it either. So I'm not sure when they're paying their next dividend. But at least for the next couple weeks, I don't think we need to worry about that dividend. So with that said, I like the idea of jumping back in there. And again, their earnings were July, which would put their next ones in October. So no real earnings risk there either. And again, that scan we had filtered out earnings anyways. So maybe 63 or 64, because we'll remember we like looking left on the chart. We look at the 5-minute. It previously bounced off 63.5. So you could either take the approach of saying, I want to sell a strike that's below 63.5, or I want to sell a strike that gives me a break even below 63.5. This is obviously going to be a little bit more lucrative for you. But, I don't think you could really go wrong either way. I think something in the 63 to 65 range is decent on STX. So STX 63 to 65p. And again, this is kind of a watch list. This isn't necessarily a list of us saying, okay, the second the bell sounds tomorrow morning, we're just going to fire capital at this. Because look, if the market opens up 0.5% and what we're holding looks good, I have no problem at all just coasting along with these positions and taking about $3,000 worth of profit on the week and enjoying the rest of my week, But if the market does dip down, that's when you start to look to these, because the idea is that these would dip down with the market as well, presumably presenting better entry opportunities. And then you have something already in the back of your mind to say, okay, I already know this is a good opportunity, or at least it was a good opportunity on Monday night. So it's probably an even better opportunity as of right now. And the very last stock that we're going to look at is VOD, a 13 strike put. This one at least is a little bit lower level of a strike. But Vodafone, it looks like if we go back to that 180-day chart, I mean, this is why it's sitting right here, right? And implied volatility, relatively steady, nothing too crazy. And I think I might need to work a little bit on some of my scans to try to identify maybe a scan that we have spiking implied volatility. Actually, I kind of have that, I believe, already. Let's see. IV rank scanner. Yeah, I think I already have that in there. But anyways, let's finish out the thought process on this. 13.16 looks like a very, very decent entry price, which is why it showed up on this filtered scan that we have. I will say that RSI already tanked pretty heavily. And it's since rebounded, so there's definitely been better. But on a 1-year basis, that's as low as RSI has gotten. Last time RSI got that low, again, you get that short-term price bounce. And yeah, long-term, it can keep sliding, but all you need when you sell these weekly options is a very, very short-term price bounce. You're really only getting 1% ROR dead at the money, though. I'm not a huge fan of that, especially with seeing what look to be low-volume candles, because they're not all connected. Price jumps around a decent bit. And that low-volume thesis, you could view a little bit more directly here is there's really no volume on this option. So not a huge fan of VOD. Let me try to intersect really quickly one time with the... where is it? The IV rank scanner as well, and see what this brings us. Excuse me. We got 15 stocks here. This is very interesting. So I think in theory, what this should show us as we go down the list are stocks where implied volatility is currently in the process of spiking. So let's look at SOXS, and I'm pretty sure this is like a leveraged ETF, which is just like a bad idea. But there you go. It looks like IV rank is 73, meaning it's comparably high. So that's kind of what we were looking for, but not necessarily the spike that we wanted from an entry perspective. That doesn't look too great. We'll look at HAL really quickly to see what that looks like. There you go. You got another IV rank that's at like 73. So the IV rank is high, but again, it's not necessarily spiking the way that we would like to see, like back here, because the whole idea of playing these IV spikes is that at some point when IV goes up, it must come back down. And when it comes back down, it sucks that option premium out for you. And when it sucks that option premium out, that's when you stand to benefit. Yes, it's running up a bit, but we like to see a little sharper of an incline, right? Bed Bath & Beyond was just such a beautiful example of that, where the thing just completely shot up and fell right back down for us. But I don't know. Let's look at those HAL options really quickly, see what they got. It looks like there's some well-established support at this 27.5 range. They've got weekly options. 27.5 is offering about a 0.5% ROR. Nothing to jump out of bed for. You could maybe go 2 weeks out and snag yourself 1.5, which averages out to about 0.75% ROR. Nothing crazy there. Some really, really nice margin privileges and much lower volatility on a day-to-day basis on this one. But, this 27 base starts July 14th, and then it got out of this range August the 23rd. So that was a month and a half in this range. So I think it'd take a lot to really knock it back down to that 27.5 level. I don't hate the idea of going 2 weeks out here just to get, a little bit greater than that 0.55%, right? Because if you sell 10 of these, you're bagging $140. So theoretically, if you went 2 weeks, you get 280, but you get more than 280, right? You get 400. You get much more option premium at that September 16th expiry. And as far as I can tell, yeah, their next earnings should be in October. So there's no earnings risk there either. So Halliburton, the 9/16 27.5 strike put,
not the worst idea in the world, especially with how little buying power it takes up and that $400 of profit you could potentially bag right there. And further, when you have these 11 day till expiry and you're playing a more IV centric trade, if IV drops off, you're probably going to collect more than a linear level of decay on these. So you could maybe by Friday collect more than 50% of that, meaning you'd get roughly, if you sold these for 42 cents the mid, that's $420 of max profit. If you collect half of that by Friday, that's $210, which is way more than the 150 you would get. I mean, not way more, it's $60 more, but any advantage, any little advantage we could get, right? But that's more than the 150 or 160 that you would get. And a $210-ish profit would almost represent a 1% ROR at that 27 strike. So I think that's a decent place to keep an eye on, the 916, and I'll throw that on the list. I think that's an interesting one as well. HAL 916, 27.5 strike put. So there you go. We've been going for about an hour and a half here. I think we have a decent list of stocks to keep an eye on for the coming week, and I think we have a fantastic bucket of stocks to jump into the week with. As those of you who have been following us for a while know, we have also several opportunities that pop up on a week-to-week basis. We love coming into the first day of the week with a nice game plan, but so much can happen on an hour-to-hour or even minute-to-minute basis that just looks too good to miss out on. We've got these SPX spreads that have been working phenomenally for us, right? We've pulled, a little over $8,000 of profit on those, and I haven't entirely updated all of them yet. So we should be a little bit more than $8,200. I think about $8,500 worth of profit on these since we've started doing this. And again, we love these because the math works out very nicely. We have positive expected value, but that's the plan for the week. So to those of you who have made it to the end of the stream, or if you've been watching the YouTube replay when you do watch it, hello to anyone in the future. Thanks for watching the stream. Thanks for sticking with us. This has been the Hourglass Trader, where as time passes, we make money. Hourglass-trader.com if you're interested in joining HD Premium. That also has the link to join our Discord server, which is entirely free for some of the channels, because at the end of the day, our goal is just to teach these strategies. But if you do want the extra little step to take your option trading to the next level, we do offer tools for that as part of the HT Premium package. But that's where we'll be all week. Feel free to give us a shout out in there, and we're always happy. We've got one free trade per week that we share in there, and that's actually been going very, very well. If you go look at our free trade of the week, if this can load as quickly as I talk, maybe I should slow down how quickly I talk when I try to load a web page in the future. But if you actually look at our free trade of the week, we give one free trade per week, and it's been working very, very well. Last week's was AMC, which pulled about $210. Week before that was Peloton for $150. We've got all sorts of these here, with screenshots just to show you just how real they are. But yeah, those cumulative free trades alone have pulled $1,685 of profit over the last month and a half. So even if you don't want to, take that leap to HT Premium, and again, everyone's financial situation is different. I will never get upset with anyone for doing what they think is best for them. But at the end of the day, we are always happy to teach these strategies for free, because I think at the basis of it, there's a lot of bad information in the market, and we want to steer people towards a more sustainable, more successful an investing strategy that puts the numbers more on your side than some of these YOLO type strategies that have, swarmed social media. But again, beginner questions, anything goes in there. We're always sticking around watching that, always happy to answer. We've got the videos explaining the strategy in HT videos, and that free trade of the week. And that's just the free side of the Discord server. So feel free, hourglass-trader.com has the invite link. Come join us in there. But again, thanks so much to those of you who tune in, week out. And special announcement right here, if you're still listening to me ramble, is that I'm out of town next week, but 2 weeks from now, thanks to the support from you guys supporting me through our HT Premium, we are going to be purchasing a new laptop to hopefully make the streams a little bit better, and most importantly with that, get a webcam. So this is going to be the last stream that we have that does not have a webcam. So 2 weeks from today, I will be live in person looking right at you as we deliver the information for the week. And hopefully we can up the production value for you a little bit, so you're not just staring at a voiceover of a spreadsheet as if you're sitting through a boring high school class. But we've got that coming, so I think that's pretty exciting. So thanks again. We will talk to you guys 2 weeks from now in person, but if you can't wait that long, Discord server during the week. But thank you so much, and we will talk again soon, hopefully with more money in our pocket than we have right now. Thanks, guys.